All right, let's get right into it. Deep down, at the very heart of finance, there's this one single, powerful idea. It shapes every investment decision on the entire planet. But what if I told you the very foundation of that idea is, well, completely broken?
I want you to really think about this for a second. Why would that be? It goes against everything we think we know about risk and reward, right? Higher risk, higher return, that's the rule. But this isn't just some weird one-off thing. It's a deep, stubborn puzzle that sits right at the center of financial markets. And if we're going to get to the bottom of it, we have to start questioning the most fundamental concept in the entire field of valuation.
And that big concept? It's called the cost of capital. Now hold on, before your eyes glaze over and you start thinking about formulas, let's forget the math for a minute. Think of it more like a philosophical question. What's the price of choosing one path over every other possible path? Every single dollar we invest in one thing is a dollar we can't invest somewhere else. And that choice, that foregone opportunity, it has a price.
So here's the key takeaway. The cost of capital isn't just about, paying interest on a loan. It's way bigger than that. It's the absolute minimum hurdle rate, like the high jump bar that any new idea has to clear just to be considered worthwhile. It is the benchmark for creating value, period.
And for decades, honestly, finance has leaned on this just beautifully elegant equation to figure it out. It's so simple. First, you have the price of just waiting around, the price of time itself. We call that the risk-free rate. Then you add on the price of uncertainty, the extra juice you demand for taking a chance and stepping into the unknown. That's the risk premium. See? Simple, clean, totally logical. But what if both parts of that neat little equation are just profoundly wrong?
And this, right here, is where the clean, crisp theory crashes head-on into messy, complicated reality. So let's do this. We're going to take that simple idea and we are going to pull it apart, piece by piece, starting with its very foundation.
Okay, so let's start with this idea of a risk-free rate. In the textbooks, they'll tell you to use a government bond yield. This thing is supposed to be our anchor, right? Our pure, unadulterated measure of the price of time. The problem is, it's not a natural price. It's not something the market just discovers. In reality, it's a number that gets shoved around by these immense global forces. Forces so huge that can literally warp our entire perception of value.
And there are really two massive forces messing with this supposedly risk-free rate. First, there's what's called the global savings glut. Just picture it. Trillions and trillions of dollars from emerging economies, all looking for a safe place to park their cash. Where does it go? A lot of it floods into safe assets like U.S. debt, which pushes the rates, the yields, way down. And then you've got the central banks. They step in with these huge programs like quantitative easing, which, let's be real, is basically printing money to buy up bonds. And they do it specifically to jam interest rates down. So what's the result? Our so-called risk-free anchor is dragging all over the seafloor. It's anything but stable.
In this quote, wow, it just nails the consequence of all that. See, for years, economists were obsessed with this thing called the equity premium puzzle. They couldn't figure out why stocks returned so much more than bonds. But this quote completely flips the script. It suggests that maybe the puzzle was never, why are stock returns so high? Maybe the real puzzle all along was, why has our risk-free rate been so ridiculously artificially low for so long?
Okay, so part one of our equation, the risk-free rate, is a mess. It's shaky, it's distorted. Got it? So now let's look at the second piece, the risk premium. And believe it or not, this is where the story gets even weirder.
So if you ever took a finance class, you learned about the capital asset pricing model, or CAP. The theory has this really clean, simple logic. The more market risk you take on, and by that we mean a stock's beta, which is just a fancy way of saying how much it zigs and zags compared to the overall market, the more return you should get. It should be a nice, straight line going up. More risk, more reward. But in the real world, the data shows something completely different. It's a stubborn puzzle called the beta anomaly. And what it shows is that the line is, well, it's almost flat. High-risk stocks consistently disappoint, and the boring, low-risk ones often do way better than they're supposed to.
Just look at this. This chart lays it out perfectly. When you adjust for risk, the very stocks that the old theory says should be the laggards, the low-risk, boring companies, they have actually generated much better returns. It's like the market is systematically, consistently getting the price of risk wrong. The big question is, why?
Well, the answer isn't going to be found in some elegant math equation. Nope. To find it, we have to wade into the messy world of human psychology and the very real structural barriers that are built into our financial system.
Okay, so think of it like this.
Picture a machine that creates this anomaly. Here's how it works. Step 1, you're a fund manager and your boss has given you a really high return target. Step 2, there's a constraint. You're not allowed to use leverage. You can't borrow money to juice your returns. So what's your only move? You're forced to over-allocate to the riskiest, highest beta stocks you can find. They're basically lottery tickets. And because so many managers are playing this exact same game, they all pile in and bid up the prices of these lottery ticket stocks, which, ironically, is the very thing that tanks their future returns.
Okay, so the obvious question is, why doesn't the smart money just swoop in and fix this? If these stocks are so obviously overpriced, just bet against them and make a killing, right? Well, it's not that simple. Because trying to correct these things, what we call arbitrage, is incredibly risky. For one, you might be right that the company is overvalued, but some very real bad news could make it even worse. Then there's the risk that irrational investors just keep being irrational, pushing the price even higher, long enough to bankrupt you. And finally, the actual mechanics of betting against a stock, shorting it, can be super expensive and difficult. These are what we call the limits to arbitrage, and they're the reason these weird mispricings can stick around for a really long time.
So, let's take stock. Our foundational models are broken. The market itself seems to be systematically getting risk wrong. So, where does that leave us? Do we just throw up our hands? No. Finance didn't just give up. Instead, it launched a quest, a search for a deeper, more powerful logic, a search for a new kind of financial gravity.
And this search has been a real journey, an intellectual evolution. Back in the 70s, we had the simple, elegant CAPM model with its one single factor, market risk. When that proved to be, well, not great at explaining the real world, researchers like Fama and French came along and said, okay, let's add more factors. They added things like the size of a company and whether it's a value stock, and that worked better. Then later on, they added even more factors for things like profitability and investment style. Each step got us a little closer to explaining reality, but it always felt a bit like we were just throwing more ingredients into the stew without really understanding the master recipe.
This really lays out that whole intellectual journey. CAPM? Too simple. It failed. Fama French? Yeah, it worked pretty well on the data, but nobody could really explain the deep economic reason why those factors mattered. What was the underlying logic? The answer, it turns out, lies in something much deeper and more powerful. It's kind of the theory of everything for asset pricing. It's called the stochastic discount factor, or SDF, and its genius is that it connects all of this back to one core economic truth.
Now, don't get hung up on the name, and definitely don't worry about the math behind it. The idea is what's so powerful. The SDF basically says this: an asset's real value isn't just about its own standalone risk. What truly matters is when it pays off. Does it make you money when times are good and everyone's happy? That's nice, but not super valuable. Or does it pay off when the economy is in the tank and we as a society are desperate for cash? That is incredibly valuable. It connects the price of any stock, any bond, anything to our collective human well-being. And it turns out, those Fama French factors for value and size, they work because they're basically just stand-ins or proxies for these much deeper, more fundamental economic risks.
So all of this brings us right back to where we started. What is the cost of capital? And I think, after this whole journey, we can see it's not some static number you can just find in a textbook. It's not a neat little formula you can plug into a spreadsheet. It's a story. A living, breathing story that's constantly being rewritten. It's the story of how we, all of us together, collectively decide to price uncertainty, how we value the future itself, and how our own messy human behaviors can shape the entire financial world in ways that our simple models are really just now finally beginning to grasp.